This week, U.S. stocks just endured their worst day since April, triggered by a surprise 100% tariff threat on Chinese imports. Meanwhile, the U.S. government is now in a shutdown, and bond markets are flashing red. If you're panicking, then you're feeling what everyone else is feeling. But seasoned investors, they see opportunity in the midst of all of this chaos.
Stick around, because a little later, I'm going to walk you through how to turn all this volatility into profit.
And we'll have a bonus tip at the end you won't want to miss. We're so happy you've tuned in. I'm Autumn Bennett.
And I'm George Mayfield, the Dividend Doctor. Welcome to the Infinite Income Podcast, where we try to help you ride out the waves rather than get swallowed up by them.
Okay, let's cut to the chase. On Friday, October 10th, saw a massive market sell-off. The S&P 500 plunged about 2.7%. The Nasdaq was down 3.6%, and the Dow dropped nearly 900 points. Ouch. So why did this happen? It may be because President Trump announced he'd impose a 100% tariff on Chinese imports starting November 1st in retaliation to China's new export controls on rare earth minerals. It could also be a market pullback.
Yeah, and at the same time, the government shutdown appears to be deepening. Key agencies have paused operations, federal workers are unpaid, and crucial economic data releases are being delayed.
Bond markets are reflecting fear. The 10-year Treasury yield has dropped, signaling a demand for safety. Also, markets are beginning to price in damage from this prolonged impasse.
So what we have is a collision of three catalysts. First, the trade war escalation, with a big new tariff threat. Second, political paralysis via the government shutdown. And number three, gaps in data forecasting and economic releases are being delayed, so investors are flying blind in a storm. Markets really hate uncertainty, and right now that uncertainty is piling up.
George, this kind of volatility can feel brutal, but you've said it before. Pullbacks aren't a flaw, they're a feature.
Absolutely. Think of market corrections as the reset buttons. They remove excess optimism, clear out positional speculation, and force investors back into fundamentals. When everyone is euphoric and valuations are stretched, a shock like a tariff threat can trigger a recalibration. The panic creates windows of opportunity to buy, but only if you're ready and disciplined.
So here's where most people go wrong. They panic sell, and that's exactly the wrong move because emotional decisions rarely lead to long-term gains.
You're absolutely right, Autumn. Panic selling when markets drop locks in losses. And historically, the largest one-day rallies often happen just after huge drops. If you miss that recovery, your returns suffer. Just stay invested, stick to your plan. This is one of those moments where you want to deploy, not withdraw.
Let's get specific, George. With markets under pressure, what tactical moves could make sense in this kind of environment?
All right. First, don't panic sell. Panic selling turns temporary volatility into permanent losses because the moment fear takes over, you miss the rebound that often follows. Emotional decisions rarely lead to long-term gains. Next, consider buying the dip. You don't need to catch the exact bottom, just stay consistent. The market rewards patience, not panic. Stay invested and buy when others are fearful. That's where the real gains are made. Now, if you're dollar cost averaging, this might be a good time to add a little extra to your regular investment. Dollar cost averaging is like planting seeds at regular intervals, regardless of the weather. So over time, you grow a portfolio that thrives through both storms and sunshine. Also, if you've got money set aside, this might be the time to put it to work because volatility doesn't just shake markets, it opens doors for disciplined investors to step in while others step back. Smart investors look for ways to reposition, not retreat. Volatility is simply a part of the journey, but with the right mindset, it can be a powerful ally.
So let's talk about some sectors people might want to watch or lean into if fear runs too deep. Let's start with rare earth critical minerals.
Tariff threats and export controls make U.S. sourcing more valuable. You may want to look at MP Materials, ticker symbol MP. This has been spotlighted lately as a U.S. rare earth play.
How about consumer staples and defensive names, which can be less cyclical with more insulated demand?
Yeah, think large beverages, hygiene, and grocery names that are historically strong in market downturn.
Here's another sector, healthcare, pharma, and medical devices.
Their demand is typically not dependent on the economy. It's often resilient in high-stress periods. Also, they're more likely to continue paying dividends reliably.
How about dividend aristocrats and dividend kings, high-yield stocks?
Income stocks with resilience can be great buffers in times like this. The S&P 500 Dividend Aristocrats Index is a helpful list. Same for Dividend Kings. These stocks have a long history of paying and growing dividend payouts, whether the market is going up or down.
Thanks, George. That's great advice. All right, now here's that bonus tip we mentioned earlier.
This week seems like a great time to consider protective collars or covered calls on a portion of your holdings. A collar strategy is like putting bumpers on your portfolio. You still own the stock, but you set guardrails. The put option acts as a safety net. It gives you the right to sell your shares at a set price, protecting you from steep losses. A call option sets a cap on your gains. It obligates you to sell the shares at a certain price if they rise to a certain preset level. In exchange for limiting your upside, you get downside protection at a lower cost, especially when volatility spikes. That's because option premiums tend to rise in turbulent markets, making it easier to fund the protective put by selling the call. So if your portfolio feels exposed and you want to stay invested without losing sleep, a collar can be a smart way to go while still leaving room for modest gains.
Before we wrap up today's episode, let me remind you that this isn't personalized financial advice, but insights from having been through many market cycles. Everything you hear on this podcast is for education and entertainment only. Before making any moves, please consult a licensed pro for guidance and advice.
Now, we want to hear from you. With these recent drops and shocks, are you adding to your portfolio right now, holding steady, or rethinking your strategy?
Let us know because we can all learn from each other. And if you found value from this episode, please follow our podcast. It really helps us grow and reach other investors.
Well, that's it for today. For Autumn Bennett, this is George Mayfield, the Dividend Doctor. Thanks for listening.
And until next week, always invest wisely and keep building that infinite income.